work in the mortgage world.
Okay. I was going to
I
say,
wo-
because, good.
I know I say I work with a lot of Jones advisors and helping them when they need it. So,
Okay.
and Michael, I work with a lot. Michael is for a financial advisor. He's incredibly savvy around the real estate piece. And a lot of advisors, I don't know,
They're not.
they're
Yeah,
not.
they're not. No, I
They
know
don't.
they're not.
And I mean it around our typical client. I call the amateur investor, right? They bought one home, moved up, and they kept the first one. And it's a massive opportunity to really improve their financial picture if they're doing it
Yeah.
as efficiently as possible. How about that?
And that's, it's funny. My background is I used to do mortgage lending for a while there.
Huh.
And I used to see, it's interesting. I had a lot of clients who would end up buying a home for, expanding their portfolio in a sense. And I tended to find it went to half group, the half that would kind of get into it, maybe buy additional properties. And then the other half were just like, I can't deal with this. It's like, you have a
Yeah.
rental, you need to understand what this is going to be about,
Yep.
you know?
Yep. Exactly.
So,
So I'm excited
Yeah.
that Michael's kind of leading the charge on this with Jones. It's really cool what he's
yeah.
doing.
And I will start by saying this. I'm going to be going into a license that will probably have things in it, Michael, just honestly, you don't have yet. And there may be some limitations that I think will be coming to Jones in time. I don't want to, I want to be careful here. I'm not sure how thrilled they would be that we go into this license, but I don't really have an Edward Jones license to go into. But what I want to start with is we can kind of talk a little bit about if you want to either give me, a case yourself, if you want to open up, if you want to even share a client you have within your own license, I'm happy to look at that. We can start with that if you want. Or just talking about the concepts of real estate within a goal-based planning system, because I know that at times can be a bit confusing.
It can.
Yeah. And I'll actually, why don't I start with kind of some conceptual things, and then we can kind of go from there and bring them up. The first thing I always like to mention when it comes to goal-based planning is that the only way that money ever leaves a plan is with the creation of a goal. In other words, when you are paying for something, you do it through a goal, and a goal can only be paid for with the client's portfolio and or savings. We do not track how they spend their employment income. And that can be a bit confusing, particularly when someone is saying, hey, I'm going to buy a new house. I'm still working. How do I show this in the plan? And the way you would probably think about that, given just an example off the top of my head, is I might say, okay, are you going to put a down payment down? They might say, yes, $80,000. Okay, where's that coming from? It's going to come from my portfolio. Okay, let's create a goal right now that will happen when you buy this house to take out the 80,000. Then very often they'll say, okay, well, I'm going to have a mortgage payment. Should I add that as a goal? Not immediately. My first question is, if you're still working, how are you paying for that mortgage? And they might say, oh, well, I'm going to use my income. Like, so I'm just going to my checking account, and I'm going to pay the mortgage. That's how most people do it. Obviously, they don't go into their savings to pay their mortgage. I don't need to see that payment until you retire. If you're still
Unless
making
it
it,
reduces, say, retirement account contributions.
correct, exactly.
Gotcha.
Great point, Michael. Which is, hey, if you're paying for this is going to reduce your savings, then I do need to know about that, because really I'm tracking your portfolio right now. Then if that mortgage is still there in retirement, it may be part of your basic living expense. And when you pay it off, I can show it being removed.
Right.
Or if you're so inclined, we don't have to put it as part of your basic living expense. We can put a separate mortgage expense and note when it will end. Because when you retire, this is now when I will be going to my portfolio to pay for things. Something that people often kind of mistake too is they'll say, well, I'm getting income in retirement, like my Social Security, my pension. Don't worry about that. Once both clients are retired, we become cash flow based. Now we need to see where the money is coming from. And if they're getting a pension, if they're getting Social Security, that's going into their taxable account, and then we are taking it out of the portfolio. But again, this can be doubly confusing to clients because they're very often like, okay, how do I show multiple rental properties with rentals received and such? So I'm going to show you a concept, and one of.
Do you want me to make you a presenter, Tom?
Yes, please, if you
Okay.
could. Yeah,
Yep.
I'm going to open up one of my.
Okay. I think I have to make you a host, I believe. I'm not Mr. Zoom, but you should be able to share now. Yep.
Okay, just give me one moment. I'm going to go ahead and go full screen on my other.
By the way, I'll add my 2 cents. I love that explanation.
Oh, thanks.
Yeah, I've worked with, again, MoneyGuide Pro since 2011 on and off. And it is a bit confusing. It's almost
Yeah,
counterintuitive.
it feels very counterintuitive if you come from a
Yep,
cash flow background. The
yep,
funny thing is the concept at first can be a bit hard, but once you get into it, you understand why we do it. It makes life so much easier. I work
yep,
also with a cash flow program too called Well Studios,
yep.
different program. I like it, but I have to be so much more precise when I am trying to get all my ducks in a row from day one to the end of the plan. Whereas with this, it just saves you a lot of time when you're just focusing on the savings. But again, that does create sometimes some confusion when we start looking at things prior to retirement and how are they looked at. So let me go ahead and share my screen here.
You're right. Okay.
Just a moment. There's your screen. Let's go to 2.
Yeah, we don't see it yet. I don't.
Not a problem. They should see it in
there
just
we
a
go.
moment.
Yep. Okay.
Great.
Okay.
So one of the things I wanted to point out, because Michael, you might be seeing this, and again, if you have clients, and Dan, you kind of alluded to it, if you have clients who have rental properties and they're receiving that income, how do I show that? Well, one of the things I wanted to point out in a financial goal plan is I've created a plan here for these clients, John and Amy. And at the first page, we ask what their employment income is. And of course, we're just simply asking, are you working right now with your W-2 income and such? That's really going to be the income I consider the income that would be paying their FICA, their Medicare. You're going to see this other income underneath. If they're currently receiving rental property, this income, this is where I'm going to put it. This is going to be the passive sources of income. So this is going to be rental property. It's going to be if they happen to have a K-1 from maybe there's a partnership that they are a part of, they get their income from that. They have alimony, child support. I'm going to put it here in other income.
Now, with
So-
that other
so-
income, does that expire when they retire, kind of like the employment income, or does it carry over?
Exactly.
Okay.
This employment income and the other income will end at retirement. It
So
will
we have to
stop.
duplicate it then if it continues.
Correct.
Okay.
So something important to understand when you get into a goal-based planning system, when I ask for their income here, let's imagine this client says, my wife and I own a property and we're getting $24,000 a year from it. The first question you might ask is, okay, when you put in this information, is this pre-tax or post-tax? It's pre-tax. Pre-tax after expenses
Okay,
is the way I would think about
that's
it.
an important caveat, right?
Absolutely. Because people will often ask, well, how do I put that in? Pre-tax after expenses.
Expenses.
Tom, can I ask you a quick question?
Sure.
So this is a good point. So is the amount I enter here, this is pre-retirement, I'm going to use your label.
Mhm.
This is different. Is this different? Let me ask it that way than the other income entries that I may use once I get into the guts of the plan?
No, well, what you're going to find when it comes to rental is when I go and add it again in retirement income, I'm going to put in the same number. I'm going to put in pre-tax after expenses. Because again, we're going to be asking for pre-tax numbers. We'll take care of the taxation for you.
So
Thomas and Michael, quick question.
Sure.
When we talk about pre-tax after expenses, what about non-cash expenses like depreciation?
No, we're not going into that level of detail here. What you're going to find is where depreciation is going to have a point is if I decide to sell this property, and then you're going to tell us what you're going to net out from it. That's where depreciation is going to come into play, but you're going to have to calculate yourself outside of the plan.
Got it.
Yep.
Okay, sorry,
great question,
Michael.
though. No, great question.
And then, so I had a question too, because you said you were going to duplicate that number, for example, but say it's 10 years in the future, obviously. So am I getting ahead of it? Are you going to address that when we're talking about like
I will.
inflation? And okay.
Yep. Great question. Absolutely. And I will get into that in just a moment. So one thing I also wanted to impress upon you here under other income, let's say this client says, you know what, we're getting 24,000, but it's my wife and I, we both own this property. Should I put it under me or should I put it under her? It doesn't matter. I could do the following. I could put 24,000 there. I could put 12,000 here. I could put 12,000 here, or I could put 24,000 for her and leave his blank. And the question they may ask is, well, why is it so open to that? Because the only thing I'm using this other income for right now, and if you're ever curious to know what you were using it, you'll see these little help bubbles. We aren't tracking it in the sense of that the money's coming into their plan. What we're just simply doing here is we're going to use this to determine a marginal tax rate. Bless you. Yeah, we're going to use it basically for a marginal tax rate. And if they want us to calculate their basic living expense, we'll take this income into account. Otherwise, we're not tracking it. We're just saying, you're telling us, to put it in here so we can do an appropriate marginal tax rate for you.
Hey, Tom, not for nothing. Great
Sure.
technical explanation there. In my case, my wife would always want it in her bucket. So
That's why I bring it up.
just saying. That's
exactly why I'm bringing it up. Yep,
Okay.
it's funny. Yeah, you got to make sure everyone's happy here. So if she wants it in hers, that's fine. It's not going to have any impact other than just simply we use it for a really marginal tax rate is what we're primarily focused on here.
Okay.
So very often people will say, well, then should I include it here? I would say yes, because later if you have earning in your taxable accounts, this could be bringing your tax bracket up, and we don't want to underestimate your taxes.
But
so we certainly want to put in
pre-retirement, Tom. Sorry to interrupt.
Correct.
Pre-retirement.
Pre-retirement.
Okay.
So let's imagine they have this. We keep it under her for 24,000. They're not retired right now. And this kind of goes to Michael's question. He said, okay, I'm going to go ahead and I need to look forward into this plan. So if I go to the top and I keep moving down, I'm going to go to money.
Yep.
Whenever you have income that straddles pre and post-retirement, you need to add it here, pre-retirement, unless they're already retired, and then you don't have to worry about it really. If they're still working, I'd add it here for other income for tax purposes.
Okay.
Then what you can do is come up to the top here and go to retirement income.
Yep.
So from that standpoint, and correct me if I'm wrong, but
Sure.
Would the MoneyGuide program's definition of retirement be basically when they switch from accumulation to decumulation?
Yes.
If
Yeah,
they're
that's the way to
still-
think of
okay.
it. Yep.
Okay.
It's when they're both retired. We're saying, okay, there's no more employment income coming in per se. We still have pensions, we have Social Security. Now it's time to, in a sense, to sort of disgorge and start paying for things with
Okay.
this, what we've been
But
saving
if they're
up
going
for.
to keep working, then we just do it there in retirement income.
Yep.
Okay.
And yeah, I was going to say retirement income. What's really neat about this is if I come to retirement income, I can see all these options. And usually you think of retirement income like a pension, like alimony, but these are things, or rental property, but these are things I could be receiving now. So if I choose rental property income,
Yeah, this is nice. Yep.
you're going to see whose rental is it. And again, I'm going to imagine it's joint. Description, rental property income. I could note maybe this is for a specific property. That's fine.
Mhm.
Joint rental. When does this begin? You'll notice you have the option for receiving now. So even though I am saying, hey, this is, retirement income. If I choose receiving now, what will happen is the system is saying, oh, okay, you're getting this right now. I might say it's going to end at the end of the plan. I could say the rental income is $24,000 a year per year. And then if there's an inflation rate, I could note it here. And what's going to happen is starting now, it's 24,000. It will inflate at that inflation rate. It is beginning now, but you will not see this income coming into the plan literally until they retired. We give
Okay.
you,
And then again, from a technical standpoint, that retirement is going to be dependent on the plan's retirement, right? If we set that for 65, 67, whatever number we pick. And then is that 24 grand a year, again, kind of coming back, say they have it set for 65, we adjust it to 67, is it going to again calculate ahead
it would look for when
inflated, what
it would
that
look for
be
when they're
worth in
both
that
retired in this case and say, okay, when they're both retired, and
Okay.
if I move it, again, we're going to just start bringing it in until they're retired. You'll see this receiving now and say, well, why, is it bringing it in now? No, it's not double counting. It's just simply saying, I won't literally see this come into the plan until they are both retired. Prior to that, the assumption is that the only thing this additional income could do that we'd care about is if it's going to extra savings or reducing the savings. That's it.
Okay.
The reason we do this is in the past, we didn't have this option. We used to just say, do it, at first person to retire, for example. But the problem you ran into is when you did your reports and the client saw that, they didn't understand it. They'd say, I don't get this. Why is it coming in at retirement? So we just said, we just change it to receiving now, and the system understands. We'll bring this in this case, when they're both retired.
Okay, so just to Tom, to make sure I'm following,
Sure.
because this has only been added, I believe, in the last couple of years, as far as I recall. I don't think there was an entry specific to this. I may be mistaken, but anyway, so pre-retirement, any excess cash flow, I'll call it, is being added to savings, right?
You would have to go in there and do it yourself. In other words, if
Okay,
they say, hey, we're buying a rental property, it's giving us 24,000, and I've already created a plan and I'm showing what they're saving. My question would be, this 24,000, are you saving any of this money towards any of these accounts, or is this just something you're spending in your day to day, or maybe
okay,
even, on the property? If they say, hey, we're not saving it, great, I don't need to see it. I just
okay,
need to put it in for tax purposes. If they say they are saving some additional money as a result, I would then put that into whatever that savings is.
okay. So we'd have to add that as I'll call it a second
Correct. The
related
system,
entry.
correct.
Okay,
The system is not going to understand if I put in additional income for the rental that it's being saved unless I tell it, hey, there's money that's being saved here. Because the interesting thing with MoneyGuide when you're doing goal-based planning prior to retirement is you're kind of creating money out of thin air in a sense.
Mhm.
We aren't tracking exactly where this money is coming from. You're just telling us I'm saving extra money as a result.
gotcha. Okay.
Can you start the savings at a future year? Let's say they're spending it now, but the plan is 10 years from now to start the saving, maybe when they go into retirement.
Well, that's what's happening here. That's exactly what's happening because what's going to happen is at that point when you go into retirement, you could do that. You could have an account saying, hey, I want to save additional money when they go into retirement. Keep in mind though, when I'm in retirement, now I'm cash flow. Now that money is coming in. And if they're not spending it, there's not any goals, they are saving it in a sense.
Got it. Got it.
Yeah, it's a great question, but that's exactly, then it becomes literal.
So, okay, not to jump ahead, but
Sure.
here's how I looked at this. When I just went and navigated through this an hour and a half ago, and having built plans like this in the past, what I would do is if there was a mortgage in place, I'd have two versions of this. So Michael, I'm just sharing like what I've done in the past.
Mhm.
I might say, okay, it's 24 grand, just using that number now for 10-year period or 7 years or whatever's left until payoff. And then I would have a post payoff entry as well, which would be higher, right? Post payoff of the mortgage. So, I just share that again. That's what I've done in the past. Tom, if you have any comments on that, good, bad, or whatever, that's feel
So
free
in
to
other
fire
words,
away.
like when you say a post payoff, you mean like a paying off the balance? Like in other words, in 7 years, I'm going to show up paying off for the balance. Sure, I would treat that as a goal. I'd say, hey, if they're going to pay off the balance in 7 years, and the balance at that time is going to be 50,000, and they have to use their portfolio, I just add a goal in 5 years saying, hey, we're going to use 50,000 to pay off that balance. Otherwise, if they're paying it just as normal, what you could do is again, you can add a liability in there if you want. So just wanted to, the takeaway here is that if you have property or income that straddles prior and post retirement, and very often we see that with rental properties, put in what they're receiving now in the personal information. We need that for tax purposes. Again, it's going to be the pre-tax after expenses. Then come here to retirement income, choose rental property, choose receiving now. We're okay with that. Again, put in the same number. And if there is any inflation you want to apply, you can do it right here and it'll start today and start moving it up. So when we see it coming in, for example, let's say 10 years down the road, it won't be 24,000. We'll see 29,000 is coming in or whatever it's now moved to at that time.
And you can customize that inflation rate too, Michael.
You certainly can. Yeah.
Yeah.
Yeah,
So-
I was actually just about to comment on that a little bit.
Yep.
If we would say track a business income in a very similar fashion, right? To say, okay, they have this and then post-retirement. One thing I've run into, and I don't know if this is our version or if it's MoneyGuide, is it limits how much you can cause that to grow.
That could be, so in other words, yeah, you may have limitations on your own side. That sometimes could be customizations you might have.
Okay. Because I found if I put business income in there, the system will not let me put more than 10% growth a year in it.
Yeah, there's probably going to be some sort of governor in play.
Okay.
You'll find the same thing if you have any, when you get to what a worksheet eventually, I do believe you can make some, you may not be able to, but sometimes we allow adjustments for returns, but we have a governor on it. We're going to stop the person who tries to say, I'm getting 25% on this asset class. We're like, nah.
Well, that's kind of, and maybe that's just a thing I have to work around and figure a way, but
Yeah, you might have.
I work with some, business
Yep.
consultants and we talk about how, yeah, we come in and we have an average of 25% growth per year working with these businesses. So it becomes a challenge trying to model that out, what that might look like. So
Well,
anyway.
well, the good news is this: if they decide to sell the business, for example, the income, you might run into some issues, maybe doing multiple incomes if you have to. Worst case scenario, maybe doing a multiple income source in the situation. But when it comes to selling the business, if they say, hey, we're getting all this growth in the business, and you're limited, remember in the end, when you sell it, you can tell us the net amount and you can tell us what it's going to be. It could be $20 million. Fine. That's what you got. In other words, you can tell us when you sell
And that
that
20
business.
million, for example, that would be in today's dollars, and then it's going to do all the time value of money and all that kind of stuff calculation on the back end for us? Or is that 20 million 10 years in the future, and then we have to try to figure that out on the front end?
You would have to figure it out in the front end, because what's going to happen if you say, hey, they're selling their business in 10 years and they're going to get $20 million, we're going to bring in $20 million. Unless you,
At that year. Okay.
Yeah.
Okay.
Hey,
Yeah.
Tom, I have a real estate question. What if the amount of rental income is a loss today, but due to reamortizing, refinancing, inflating the rents?
In a situation like that, what I would probably do, again, you could handle it sort of the same way. I might go to the first page and put 0 for the income. So it's not affecting my marginal tax rate because I'm not showing on my tax returns any income coming in. And then when I get to retirement, I could sit here and put in, I could basically come back here again and say, what's the amount of the rental income? And whatever I think it's going to be at that time, I could either say, hey, it's starting when they retire.
Oh, got it.
Or you could just say this, and you could sort of play with it, if you see what I'm saying. You can sort of
Yep.
massage it to work what you need it to.
Got it. Perfect.
Yep. So again, remember, pre and post, you want to do it in the personal, and you also want to add the rental property here. Something else.
And then one other question. This has to do with the base inflation rate plus. I've heard some different things, and I just wanted some clarity on that. So is it already incorporating some kind of inflation rate to
It is.
do this? And then if you just choose base inflation, it will go at that. And then if we do base inflation rate plus, it's going to already incorporate that inflation rate plus like 1% or 2%. Or
Correct.
something like that.
It'll do a premium, but you can also use a negative number too if you don't agree with it.
Okay.
You might say, hey, I don't like the base inflation rate of 2.62. I would think it's 1.5. Well, you can go in there and do negative 1.12 and it'll do it for you.
And I think, Tom, isn't it true that you can also model different inflation rate assumptions in the what if worksheet? Can you still?
You can, but I'm not. Jones doesn't have the what if worksheet just yet.
Okay.
And I'm not sure if they lock that down or not for customizations.
Okay.
Yeah, I've seen some places that don't let you play with those inflation rates.
Yep.
So hopefully, Michael, if you have your own, version open, you're seeing some of the things you might even say, hey, I don't see that. There could be some customizations, and there could be things that are coming that they just haven't done yet.
So far, everything I've seen.
Good.
I know we don't have the what if, and I do know that we can adjust the inflation rates, but usually there's a default plugged in, and then we would have to manually go in and change it.
Okay.
Yeah.
I don't want to add to any angst there, Michael, but the what if is really an amazing tool. I hope you get access to that.
Well, I know. I saw your video on modeling out the mortgage. I was like, hey, we don't have that.
Yeah. I mean, that's the guts of it. But anyway,
I'm told at least we're going to be able to run scenarios with a future version. So I don't know if there's multiple ways to do that, or if that would just be the what if worksheet.
Yeah, I'm not one to tell you up. I imagine it's going to be the what if worksheet, and I can't promise anything or ETAs, but I think pretty much that's coming to you guys. I'm just, like I said, I'd be surprised at this point, but it's just, I think it's a little early at this point that they're looking into it. Yep. So at this point, right now with the rental property income, that's going to be the concept. I'm going to go ahead and done for a moment. Do want to quickly just note to you. So right now there's that rental property income. 24,000, and it says beginning in 2024, but and I don't know if you all go here or not. So I can get up here, the current scenario. I'm going to go ahead and just turn that on real quickly. Michael, I don't know if you use this tool or not, if you use the combined details to check your work. But if you're ever curious, whenever you run a Monte Carlo scenario, underneath you're going to see this Explore menu. I think you all have the Explore menu.
We do, and we
Yep.
can't get to it. It doesn't pop up automatically like it did on yours. We have to go digging.
Well, it's worth looking occasionally because it's a great place to check your work. If you go to the Explore menu and you go to Combine Details,
Mhm.
this is basically a way to see the plan womb to tomb on a 30,000 foot view.
Yep.
And if I go ahead and bring this out a little bit, go ahead. Sorry, this thing's got, the zoom's got the top there. So let's go and just boom. What I can do now is, what I can see is post-retirement income. There's nothing there, but if I go to 2034, when they retire, I can go in, post-retirement income, and there's that rental property right there. And with the inflation, it's 30,722. So it's coming in. But you'll notice prior to that, it's not, because our assumption is you're spending it. You know, unless you tell us otherwise and you increase your savings as a result, we assume it's not coming in. But once you're both retired, now we're cash flow. That's coming in and we're paying for our goals using that information.
Yeah, to me, I love that, Michael. I love this table, you know.
Yeah, it's I always like to tell people this is something you could even share with your clients. But here's the one thing to always remember is that every number on this page is wrong. In other words, it's using an average rate of return. No one's going to get that, but it's still a fantastic way to understand what's happening in the plan. So if you come here and you want to check your work, let's imagine I put that 24,000 in as a month. You know, I might see this humongous number in post-retirement, like what's going on? Then I can check that and go, oh, I put in 24,000 a month. That's why I'm seeing this huge number. And it kind of helps you check your work. So each one of these years is a different link. I can see what's even going on in that year. Post-retirement income, investment earnings, funds used, everything. So yeah, the combined details is a fantastic page to utilize if you want to understand what's going on. I'm gonna go ahead and close that down. Something else I wanted to point out, going back to money, we are going to ask for liabilities. This again can get a bit confusing. People will see liabilities and go, oh, okay. So I'm going to enter maybe my mortgage in here. Keep in mind, anything I add to liabilities, we are not going to amortize. We are not using it for anything other than your net worth. That is it. So if I add a liability in here, all I need to put in here is actually the outstanding balance, and that is really it. That's all it needs to know. Because the attitude is, oh, you're paying for this with your employment income. Fine. Now, when I go into retirement, if this liability is not paid off, I could add it as a goal because now it's being paid for with my portfolio. Otherwise, when you add liabilities, they have no impact on your probability of success. I could come in here and add $2 million of liabilities and I'd still be at whatever my last number, my probability is at. Because the assumption here is it's only affecting your net worth and that you're paying for it with your employment income.
Tom, quick question. So I did this earlier. I guess the couple was retired and it also had a field asking me for the beginning balance. That leads me to be hopeful that maybe it was that amortizing it in that situation.
Well, what you're going to find is it's a little more complicated. It will amortize. If you give it a interest rate payment and a monthly payment, it will amortize it in our life insurance analysis and our estate module, but nowhere else. If they're retired and they're paying for it, it's going to be something of a goal or be built into their maybe their basic living expense.
Okay. Well, I hope on my tombstone someday I can have a proclamation. I convinced Tony Leo to add true amortization into the guts of MoneyGuide. But I digress. But I've had this conversation 10 times with Bob Curtis even back. Anyway,
yeah.
Okay.
There is some true amortization that can be done, but it's not being done in the way you think it is. It's just like.
Okay. So again, wrapping my head around this, very often you're going to have a couple where they have a mortgage that's going to span pre and post retirement, right? So would we want to put here in this total amount, the current, what it is at retirement, then add a goal in like pay off the mortgage because there's 100 grand left on it in whatever 10 years, whatever it's going to be, right? Do we need to put that goal to pay for it? Or do we just put that in the housing expense and have it drop off? Like,
Great question. Great question. Because there's two ways you could do that.
Yep.
Okay.
And I saw Tom putting his thumb up and he's right. And there's another way to look at it. So,
Yep.
but what I would say, Michael, let's say it's imagine their primary residence, and this is the mortgage for the primary residence.
Okay.
The way I would think about that is, let's see here. If I can get back. I always have to find how to get around this because there's a thing at the top here for.
You can drag it. You should be able to
Yeah.
Can I-
drag it to the
can I
side.
drag-
Yeah, the Zoom thing. Yep.
There we go. But now it says the meeting is being recorded, and I'm going, can I move that? I can't see that. Oh, wait, let me just put okay there. There we go. That's fine. There we go. Good, good, good. Sorry. There was a thing saying it was being recorded. Was I okay with it? I'm like, yeah, I'm okay with it. Okay, so wanted to note, you're saying, hey, what if I put in their liability for their primary residence? Should I put in a goal? Well, in this case, for example, when I went to goals, there's two ways you could do it. You could have it in their basic living expense. If it is part of their basic living expense, I would say, okay, it's part of that. And then I could just simply say, hey, the mortgage is going to drop off in 2040. I can add basically expenses that end during retirement and say, hey, look, they're paying $19,200 annually on this. As you'll see here, $1,600 a month, and it will end in 2040. And that's fine. If they're saying, hey, that's part of our basic living expense, and then when the mortgage is paid off, it just reduces our basic living expense, and we're happy with that. If you wanted to, it's up to you. You could say, you know what? I don't want to have it as part of their basic living expense. I could reduce that cost accordingly and then put it as a separate goal and add a mortgage goal here, just stopping in 2040. I think for the primary residence, it's fine to keep it in the basic living expense if that's the way they see it. The question becomes, what if they have second or third mortgages for rental properties? I might put those as separate mortgages and not put them as part of the basic living expense for control purposes. If they sell that, I can get rid of that. But when it comes to the basic living expense for their primary, I tend to think of that as being baked into this. You don't have to handle it that way, but that's the way I see their primary. But if they start having a second home, a third home, or multiple mortgages on rentals, I'd probably put those as separate mortgages, as separate goals if they're paying for them in retirement.
Okay.
Because what's
Makes
going to
sense.
happen in retirement is you're going to have, actually, we're going to start seeing that rental income coming in, and then it's going to go into the plan, and then we're going to pay for that mortgage goal. So that's reality in a sense. Does that make sense?
Mm-hmm.
Yep. Also, when selling the property, do keep in mind, let's say if I am adding in a other asset, this is going to be the rental property itself. Let me go ahead and
Right.
just add that in. I'm just going to add one. I can go to home, personal assets. Let's just
Now, did you put it under personal assets or
Nope.
the next one was business? And
Yeah, I'm with you on that one.
Okay.
That's probably the way I'd handle it. Real estate. I'm just real estate. Whose is it? Let's say it's jointly owned. If what kind? Let's say survivorship. Current market value. Let's say it's 450,000. And expected growth rate. Let's 3%. So when you put this in,
Now, that expected growth rate, is that on top of inflation or not?
no, this is just basically you're telling us the growth rate. We are
So
not
if we
applying
put in
inflation.
zero, it's just assuming it's not going to grow at all.
Exactly.
Okay, so we have
Yep.
to put something there. Okay.
Yeah, you would have to put the growth rate in there. What you're going to find is if you tell us that you're not looking to sell this property, do you intend to sell this real estate to pay for your goals and say, no, nothing more is going to happen to this. It's just going to grow at 3% until you get to the estate module. That's it. We are not assuming anything is being used here. It is just growing. It is not part of the portfolio. Now later, and this would be something you might want to call the support team about, if they say, hey, they're taking out a line of credit against this, they can kind of walk you through how you might want to model that. But in a sense, we're not selling the property. But if they decide to sell the property, do you intend to sell this for your goals? You could say yes. Tell us when it's expected to be sold. Let's say when they're both retired. I'm just kind of giving an example. And then you're going to see a cash receipt schedule. And you would put in the amount they would net from the sale at that time. So if I put in there $200,000, what's going to happen is when they both retire, $200,000 is going to flow into the system and be reinvested in their portfolio. So I am saying the net amount I think they're going to receive. You will see, I don't know if this is part of EJ or
Yeah,
not.
I was gonna say, I do use that to try to figure
Absolutely.
it
I think this
out.
is great, particularly if it's a primary residence, because let's say imagine their cost basis was 75,000 here. So this is a rental property. If it was a primary, I might put in 500,000, just thinking of that 121 exclusion. You're always going to have that. Pay off the debt. Notice that pay off the debt 0. I don't know what that mortgage, if I had a mortgage I put in for that, for this thing, I wouldn't know what the balance is. I'd have to figure that out and say, okay, if there's, what's the balance? Let's say 65,000. Sales expense, let's pay the realtor 6%. And then the tax rate, anything above and beyond is 20%. And this is a referential calculator. It's saying, okay, if we sold this given its growth rate and there's other expenses, you would net out 404,781, and you would come down here and then put in 404,781. And what's happening there is we're saying, okay, we're going to kind of help you figure out what's going to be coming in.
Yeah, I
Very
was just
importantly,
looking at
though,
that the other day, so that was cool.
keep in mind, though, if I had rental property coming in from this, I want to go back to retirement income and show it stopping, when this occurs.
When you
Because those
sell
two
it.
are not necessarily connected in a sense. This is not going to understand that that rental income has to stop when this is being sold.
Well, like Tom said, I'd like to put a suggestion that you have that linked so it just will auto populate.
Yeah.
Yeah,
Yeah.
that's sort of the nature that you have to, some of these things you have to keep in mind. That,
And sorry, I didn't mean, okay.
Oh, no, good.
Yeah. And so you're not, if this is a rental property, you're not, there's not a field for like depreciation recapture or
No.
none of the tax. It just has estimated. So what, okay, that estimated tax, then what is,
Now, what's going on there is that's just simply saying if there's anything above and beyond the cost basis. Again, keep in mind, this is a referential
it's
calculator.
just using a flat. I
Yeah,
got it.
you may
Good, you
find
made that.
this
Gotcha.
is
Gotcha.
particularly good for maybe a primary, but to your point with recapture tax, that's not
Okay.
getting into that level of detail. You would have to say, well, we have recapture tax here too, so, and then you'd have to calculate it out yourself.
And
Wouldn't
so
you be able to fudge that by fudging the cost basis?
You might be able to, but I want to be
Right.
careful before saying that's how to do it. There's that.
I would just play personally, Michael. I would play with the blended tax rate. You kind of can figure out what off screen here, if you will, just figure out what your your number's going to be, and then just load that in, and you could kind of play with that as far as the percentages. So Tom, not just to hold on the screen for a second, but I don't want to
Sure.
lose a thought. Like you entered that liability, that other mortgage. I guess that was in the pre-retirement context, right?
Mm-hmm.
How do we, I was just trying to think off the top of my head, how do we get rid of that from a liability perspective at a future date? Is that just adding another goal and showing that as a payoff, or?
Well, it already is kind of built in because remember, what
Okay.
I've got down there for the liability is where they stand now. We're not looking to the future. We're not doing net worth in the future. So
Okay.
if they have that,
sort of
that's right.
answers it then.
Yeah. And net
Gotcha.
worth isn't going to have any indication on the calculations. Very often what we tell people when it comes to liabilities is if you want to update it, you can either update it manually every time you're meeting with the client, making sure the balance is correct, or if you have it tied to some sort of integration, if that's possible, you can integrate and just it'll update itself. But keep in mind, liabilities only affect the client's net worth today. So looking forward, we're not really taking it into account.
Now, if we do a 1031 exchange on this, right? I'm trying to think of like, can you make the tax rate 0 and
Sure.
then,
You could start, I would say that might be something to contact, our support team on, because in a situation like that, what's going to happen is you're going to get rid of one and just add another property.
yeah,
And then whatever your
Or-
boot is, you could show it's money coming in, or something of that nature. We're just not going to get into the details of that 1031 exchange. You're going to have to kind of tell us the results of it. So now this property is gone. Great. Get rid of that. Now put this property in. Great. No problem. Was there any
Yeah.
tax result? No. It's just now you have that new property. Did you have to pay any boot? Okay. That's a goal. If you had to pay out of your, if you had to pay out of your portfolio, or if you got money, okay, we can add into account with the savings going in and just showing it going to your taxable account.
yeah.
So yeah, it's doable.
Okay. Interesting. And if you exchanged into a DST, I'm just off the top of my head, like to me, I would show this, then take the net amount, create a new asset, DST, whatever that you're invested in, and then just create additional income to reflect the cash payments that you're getting from the DST.
Showing my ignorance, DST.
Delaware statutory trusts.
Oh,
So when you do an exchange, rather than buying another like kind property or just investing in, it's essentially like I call it a real estate fund, but that's basically what it is. You're
interesting.
avoiding the taxes on that if you invest all your proceeds net, if you don't have a boot, that you're not
Interesting.
subject to. Anyway, not that I don't
Sounds
know,
like
Michael.
exchanging for a REIT.
It's sort of like a
Similar.
REIT. Yeah,
Yeah.
yeah, yeah.
Interesting.
Michael, I don't know if you had that need or not, but I think you could model that here. I think it's just, to me, a lot of this is workarounds,
Yeah, in that situation, Tom, what I'd be thinking is, like you said, it would be a workaround. I'd get rid of the
Yep,
property and then show
yep,
the deposit for the money and and then show whatever those investments would look like.
yep,
What you think would be if you have a symbol that it can bring in, that's great. That way you'd have an idea of where
yep,
it's going. Otherwise, you'd probably have to choose the asset classes you think best reflect that DST.
yep. So we've got about 10 minutes left before I have another gang coming on this. Michael, what else do you want to see? I don't know if you've seen the QPerts. They've got some pretty neat functionality for that. But what else?
I haven't modeled that out or wouldn't know how to do that. I know you sent over the the video on how to do a reverse and stuff in there. I'm assuming other Tom here.
Sure.
If we were, say we had multiple rentals or some commercial property or something like that, that we would pretty much just model it out the same way with multiple
Yeah.
assets,
Yeah.
multiple
You just want to keep
incomes,
an idea of what
multiple.
liabilities are connected to what, and when you're creating
Okay.
goals, I might connect them I might say this goal is the mortgage for this property,
Yeah, I
and
usually put the address in just
okay.
so they know what it's associated with.
It's funny. We often say to people when it comes to their primary address, you don't need to put that in because we don't work on social securities or primary addresses, and it just kind of protects the client. So rentals, it becomes a little difficult when it comes to rentals because rental 1, 2, and 3 become very difficult to understand. But for primary resident, you may just want to put home. You don't have to put in their home address just to protect that information, maybe.
Okay. And then maybe I would just kind of move over to reverse mortgages here. I know Tom sent that video. But
That is though in the
a
what if
lot of it was
worksheet.
in the worksheets. I can't use the
Right.
worksheets yet.
Yeah.
And
Yep.
just kind of wondering what might have been updated or added in over the past couple of years to get up to speed on that.
Well, when I think of a reverse mortgage, and I know we have a reverse mortgage option here that helps, I believe, with some calculations. You don't see that yet, Michael. But the way I think of a reverse mortgage is the client receiving money, kind of a reverse equity line. They've taken out the home is basically, they still live there. They're just receiving income from the sale of that. One thing I might want to think about if you were trying to show a client receiving a reverse mortgage is, again, I might be thinking about retirement income. But where you want to be careful is very often we tax it. So I don't know exactly how the taxation works on the reverse mortgage. I would imagine it's not. Maybe I'm wrong in that assumption.
No, that's correct.
Yeah,
Yeah.
one thing you might want to consider is if you come here under the retirement income, if I come down here, there's something called other income.
Mm-hmm.
I can make that choice and you will see the option here, is this income tax free? So you could choose other income right here. Again, description, maybe reverse mortgage. When does it begin? When does it end? Here's the amount and it is tax free.
So how would that percolate through all the way to the estate? Say they carry that all the way until they pass, but they've been borrowing against their equity.
Yeah.
There's some kind of interest rate associated that reduces the overall property value.
Yeah, that becomes a little more complicated because in a situation like that, you'd still have, for example, other asset or home. It's in there, but maybe you'd reduce the value. You might say, hey, the value is very limited, or maybe I put no value in there and say, look, when they die, this is not going to be part of their estate. The only thing that's part of their estate is the additional money they were receiving that we've brought into their taxable accounts. So with other assets, you might even create that if you think there's going to be no balance left on the asset, the home, I could say, hey, here's the other income coming in from the reverse mortgage and just get rid of the other assets. So when you get to estate, it's not there. It's like, look, the home now goes back, or you could reduce the value significantly to reflect what would be coming into the estate would be greatly reduced.
Or if it's at a regular rate, would you be able to put, say, a negative appreciation rate on the property too?
No, because the only thing you'd be able to do there is just tell us that there's going to be a lower amount received. We wouldn't be able to do a negative rate on that, like a negative appreciation. You couldn't say, hey, -5 for the appreciation rate. It would just simply be, you just have to calculate what you think the value would be and then put it in there for value, and then keep that in mind for the estate.
For balance sheet purposes, would like say annual review time, could you just update the mortgage balance
Sure.
and update the home value?
Yeah, you could do that. In other words, you're saying like a liability. Try to treat, in other words, put a liability in there for whatever that you owe against the reverse mortgage, and then keep the balance of the house in there for net worth purposes, certainly. But do keep in mind when you get, I'm trying to think, yeah, the liability would have to be paid off when they die. So that might be another way of handling it, is to put a liability in there, and in the estate, we'd see the liability, and then you could put the value of the home. We'd take the liability into account to reduce the overall estate value. So that might be another consideration or a way to handle it.
I would just share that what I've done in the past with others would be just, if say you started the reverse mortgage today, and then at the end of plan, we would just look at an amortization schedule outside of the system, right? From someone like Dan, and say, okay, what is that balance when the client turns 93, 95, whatever? And then we would just show that as a goal, as a payoff. And that would for
that's
planning,
not a bad idea
right?
at all. That's not a bad idea at all.
Yeah.
That's still a liability to also still to be paid off, but I like that idea too, Tom, because it takes
Yep.
care of it.
Yep.
Cool.
Okay.
Appreciate it, guys.
Yeah. It's going to say great conversation. Great questions.
Well, it's funny. I'm Tom, I'll circle back with Chip and the others, because I think having you all on to really do kind of an intensive session just to show how you can model investment properties, real estate, whatever, and we could kind of flush that out a little bit more. I think showing like 1031 exchanges, etc. Again, just showing other income, and we could label it DSTs, REITs, whatever. But I think it would be kind of fascinating. Of course, I'm always thinking about new webinars. So,
well, one thing I would also say too is to Michael and Dan, if you're doing this, Michael, I think you have access to. Hopefully, it is going to say eventually you'll have access. You have a support team that can help you. And they may even call us. I don't know. Don't be shy about calling them with anything.
Okay.
Or Dan, same way. If you're working with the program, we have a support team just for things like that 1031. That's something off the top of your head. I'd say, even if you're like, I'm not quite sure, call them. They will help you out in trying to put that together.
Yeah.
I can definitely work through them, but I'm thinking we have 20,000 advisors that are moving over to MoneyGuide, and it would be great to just have some set, like, this is how you put in a mortgage, this is how you put in a secondary property, this is how you put in a reverse, this is how you put in a business owner business with a sale. Just I think that knowledge is lacking so far, and it's been really piecemeal. So,
well, again, you'll be getting more tools that will help you out with that. I feel certain of that.
Okay. Good. All right.
Yeah, Michael, I would say to, anything I can do to help going forward, happy to do it. On the reverse, I can say I've modeled 1,000 cases, and I actually help design what is in MoneyGuide. You may know that. And so I'm fairly familiar with, but anyway, and then I've done the rental properties and stuff. I've done 3 different 1031 exchanges. I've had modeled rental property scenarios in here. So again, anything we can do to help, happy to do it. And certainly the folks at MoneyGuide are wonderful, and can't praise them enough.
Well, I'll definitely keep that in mind. I think what I'll do is actually do like kind of a real needs analysis first, so it's not kind of going off half-cocked on anything and stuff like that. But just, I know there's a big need just in my region. Everybody's here like, oh, we'd love to hear about how to model, rental properties, and to know the best way to put mortgages and stuff in there, and that kind of stuff. And I just think that acumen is lacking right now. And I'm sure it's not just my region. I'm sure it's across the board. But again, before we put anything together, I would say, yes, I'll lean on you, but I want to find out exactly what we want. And then that'll make it easier to target, is all.
Okay.
But yeah, I really appreciate what you have all put together. This was a great conversation. Tom, I always appreciate, FEN. It's great.
Great.
A lot of good stuff. Dan, thanks for the intros to everything. This is awesome.
Great. All right. Happy
All right,
to
folks.
Thanks,
Tom,
guys.
Take
Tom,
care.
thanks for jumping on. Really appreciate
Not a problem
it.
at all. Not a problem.
Okay.
See y'all
All
later.
right. Take care, everybody. All right.
Thank you. Bye.